Good morning. Happy Thursday, Chichi fams.
Good
I
morning.
see I see somebody's on already. What's going on, Chris? What's going on, Jim? NC in the house. That's right, Jim. You're from North Carolina. I forgot about that. Chris Gregorio. Chris Gregory, my bad. He was first. He wanted to make sure of that. Okay, all right. Well, today, me and Lisa today. Market update, of course, as always, every week, just to kind of keep you guys updated on what's going on in Sacramento. Um, and then Lisa's gonna talk about mortgages, paying it off early. So I kind of want to hear about that. I know we get people asking about that as well too. Like, what's the benefits of paying it off early? Should I pay it off early? Um, is there anything I could do to pay it off early? Like things like that. So Lisa's gonna go over all of that. Um, and we're gonna probably close it off with answering questions if you guys have any for us today and reacting to some more videos. There's a few more videos that we're gonna be reacting to. I haven't seen them yet. Lisa hasn't seen them yet too. You guys haven't seen it yet too, unless you guys are always on TikTok and YouTube. Love y'all morning chats. Great for me to listen at the office. Yeah, man, it's good to see. It's good to have you, man. I'm glad you are always on, man. We're glad you're here too, Jim. Okay, let me just share my screen real quick so that way we can go over market updates. There's the lovely chart we love to see. All the green colors. Inventory is slightly going up, Lisa. So from last week, inventory went up 4%. That's good. Very good. New listing is also up 5%. Sold homes are up 8% from last week. Pending homes went down 10%. Okay. Now, month to month, inventory is up 17%. Wow, that's really good. New listing is also up 97%. Wow, okay. Sold home is up 150%. Okay, from last month. Pending homes are down 26%. This is month to month, which is looking really good. Inventory comparing to last year, it is up 40%. New listing from last year, it's up 282%. Wow. Okay. Sold home is down 72% comparing to last year, and pending homes is down 30% from last year. Okay. It's starting to pick up, which is good. Everything is starting to pick up. Have you been noticing that on your end on the mortgage side, Lisa?
Oh yeah, but this is kind of the norm, right, Chia? It's May. School's going to be
Mhm.
out in the end of the month for some places and things like that too. So May, June, July, those are the hottest months.
Yeah, and the weather's starting to be very nice, like it's in the 80s lately.
Yeah.
And people are making moves. They're either deciding, you know what, we need to sell now, go to a different area, upgrade, downgrade, do what we gotta do. So this is gonna be the season starting from here on out. So yeah, it's pretty typical. I am curious to see how the market's gonna do overall, but so far it is doing well, comparing year on year, which is what we like to see, right? We always want more inventory for all the buyers that are looking. What's up, Randy? Randy's on, Lisa.
Yeah. Hey,
Yes,
Randy. It's been a while.
it's been a minute. Yeah, I know. Well, it's probably too early for him. I'm just playing. But yeah, inventory going out, that's really good. Hopefully more come in, not just that, but like in our new listings overall. All right, let's go average price per square foot. Thanks For sharing your knowledge. Enjoy listening to these during the morning. California affects the rest of the country. Trendsetter. I don't know about that, man. NC's probably better than California in some ways. Okay, average price per square foot seems pretty steady. No change from last week. But from last month, it is up 13%. Okay, and
Wow.
then from last year, it's up 16% on average price per square foot. Let's go over the days on the market. Look at that. Days on the market on average went down by 5 days, y'all. That means probably cash offers are coming in, or people like Lisa are just doing a heck of a good job on the underwriting for the job for the loans. You know, I mean, look, average days on the market right now is like 16 to 18 days. Look, this is from last comparing month to month. And last year, same time, it was 40 days on average. So, man, okay. Interesting. Very interesting. This normally tells me there's a lot of cash offers right now in the market. So for since we're in California here in Sacramento, probably Bay Area, probably Bay Area again. A lot of people that are selling their assets and liquidating it and buying real estate. That's the only thing I can think of. Randy says, I heard there's no inventory. Is that true? And mortgage applications dropped below 2008?
I wouldn't say no inventory, but very low inventory.
Yeah, there's very, very low inventory. As far as mortgage applications, that's a question for Lisa.
It
Is it
is. It is.
lower?
Yeah, it is absolutely a lot lower. People getting a little bit more discouraged, and they're thinking with the home prices going up, interest rate going up, and everything like that. But as you guys see, we do this data. Chia does this data every single week, and time again for so many years now, right? Chia and I have been doing this together for how long now, right? And it
Yep.
continues to rise. Most, if not all, of our clients who haven't bought when they first came to us continue to feel that pain of waiting.
Yeah, it's always the same, right? Like whether it's this year, last year, or the next. um Clients that are waiting on the bench for everything to kind of cool off, right? Or the
Yeah.
market correction to happen. They come back and they're like, what? I'm tired of waiting. It's not gonna happen. And each
Yeah.
year that I wait, it's getting more and more expensive for me to buy the same home.
Exactly.
So,
Exactly.
and that's been the truth, especially here in Sacramento. So I just don't know what it is about Sac. It's we got great weather. Even though sometimes it's bipolar, it's hot and then it's freaking cold the next week. I don't know, but there's something about Sacramento that's making it the way it is right now. So, yeah. One
Well,
thing I can also go ahead.
sorry, I was going to say we're just really, really super growing, but everywhere where we have Sacramentans moving to Fresno, moving to Bakersfield, places like that, we have still plenty of people in the Bay Area moving to Sacramento as well. That's
Yeah,
affecting it.
and I was gonna say, like the fact that these average days on the market, is so low like this, it might not necessarily be a all cash purchase too. They might be like getting access to this cash because they have so much equity in their other homes. So they're probably pulling out money by HELOCs. Because I've been hearing a lot about that. People pulling out HELOCs, buying a home. They're um, they're finding creative ways to um get that cash, and then
Absolutely.
buying real estate with it.
Absolutely. And using that HELOC or any other assets that they may have to pour into another house without selling their current house, which makes the inventory level even lower, right?
Yep.
And you guys see earlier when Gia mentioned from last month to this month, inventory went up over 13%. And people are still, caught up. And I've stressed this before. Don't walk over dollars to pick up pennies. This is the exact reason why we talk about this, because even though interest rates in the last, I would say since COVID till now, 4 years, okay, from 2%, 2.5% to now 7.5%, right? And people are on the fence on that, but yet every single month you see the trend, guys. Only 1 month and it already went up 13%. So you're worried about the 3 to 7% interest rate that could absolutely change when the interest rates change. You can refinance, but once the house is gone, once that inventory is gone, it's gone.
All right, moving on. All right. Average active price right now is $757,000. Okay, so that went down from last week 1%. But the sold price went up 8%. Average sold price right now in Sac County is $614,000, y'all. Medium homes going up in Sac County. So active price again, it's down 1% compared to last month, but I care more about this. Okay, this is a bigger indicator of what is going on. And look, it jumped from last month 36%. So the average home that is selling right now is priced around $709,000, y'all.
Wow.
Mm-mm-mm. Isn't that crazy, Lisa?
It is crazy.
36% from last month and 31% from last year. Oh, I lost your camera. There you are. Yeah, so if somebody is telling you guys, the market's going down, prices are going down, I'm seeing it, I'm feeling it. No, we're not seeing it at all. At least again in Sacramento here, it's up. I mean, data don't lie, like me and Lisa, we don't wake up super early and prepare this a week in advance. Trust me, we're not that savvy, y'all. Um, it's a lot of data, to go over, and these are like hundreds and thousands of homes that's being sold, that's being recorded. So yeah, the data don't lie. I always look at data, do my own research, and you guys could do your own research too in your market or even in Sacramento market, and then you know compare it that way, and it's not gonna be any different. So it is up. Average sold price right now, it is up 31% from last year. Thank you for the data and hard work. Yeah, Jim, for sure, man. Data is everything. Sharing it with all you guys so that way you guys could be equipped when you guys are out there shopping. Because without data, what are you gonna base your decisions based off? Your analysis, all of that. And look, inventory's up. This don't make any sense. Mm-mm-mm. Yeah, that don't make no sense.
Well, it is the first or the second too, Chia, so it may not have reflected properly
That's
yet.
true. It is in the beginning, so this is way off. I feel like this is probably more accurate, 1.4 months worth, but then again, this is the March and this is February. So they don't have May yet, y'all. It's just too new. They
Yeah.
don't even have April yet either. So that's shocking because normally there's April here at least. But for sure I know we don't have 8 months worth of inventory. And for sure I know we don't have almost 4 months worth of inventory. So this is way off somehow, some way. Okay. See, if I was doing this, it'll be something like this. It'll be way off. But it looks like they haven't had all their reports yet. So
Yeah.
we will have to circle back next week. But I'm sure it's still between the 1 month worth of inventory, way under two months. Okay. Um, all right, and that is the market update. If you buy cash, does 7% mortgage rates affect them or it doesn't apply? It's not gonna apply. If you're cash is king. You don't have terms like appraisals having to come in, add value. You don't have loan contingencies. You only have your inspections contingency if you so choose to use it. There's no rates on your cash unless you're borrowing that cash from a HELOC. Then yeah, there's definitely interest rates.
Yeah.
So otherwise, cash, no interest rate. Have y'all thought about labeling this as a morning podcast? It is a morning podcast, but like I probably in the future we are. Because we just started doing this morning thing. I know it's been a week on week that we've been doing it now. Um, yeah, it's definitely a morning podcast. I mean, you guys are calling it what you guys are calling it, but for us, it's just a market update for everybody else that could join. But yeah, what would be the difference, Jim? Morning podcast? Because if I call it a morning podcast, then people that come back and watch it on the archives or replays, it's not gonna really like relate. I'm from Sacramento. Is it a good market for first time home buyers? Everybody's situation is different, Chris. Good question. That's always the $1 million question, right? Is it a good time for first time home buyers to buy a home? And I would just say this: if your situation allows you to buy a home and it's gonna be able to save you money in the long run, if you know you're gonna be in there for at least 10 years, I would say probably buy, because long run you're probably going to be able to save more money. So for example, I was just saying this to a person the other day. If you're buying a home, buy the home that you need. Don't buy a home that you want. So for example, let's say you're a single person, only you. Maybe you don't need a 5 bedroom or a 3 bedroom. Maybe you just need a 1 bedroom or a 2 bedroom at the most. The reason why I say that is because then you're buying it based off of how you're living, right? And then because the market is the way it is right now, with the rates being the way it is, the price being the way it is, competition being the way it is, you're buying based off of your need. So then it's more affordable because the bed count and the size of the home. So then when you're doing that while you're paying down the mortgage year by year and your home is appreciating, like what we've been seeing, when the market is more favorable to you, then you can sell and use that equity to build it down for the dream home that you wanted. Maybe then you can get your 3 bedroom, 5 bedroom, whatever home you want, and it'll be more favorable to you. But if you are only planning on being in the home less than 10 years and you already know you're gonna be moving year to year, you like that lifestyle, or you're not sure about if you're gonna be in California forever, you know, you're planning just flipping your home and taking advantage of the market, it's probably not gonna work in your favor in that way right now with the way interest rates is. So unless you find a super, super good deal. But for first time home buyers, most of the time they want something that's move-in ready. So that means you're paying market price for it. Then in that case, I would say just rent and save up and work on your situation until you have the resources to buy so that you make it favorable for you. Lisa, what are your thoughts on that?
So again, it just case by case, right? Case by
It is.
case. To me, I always say, if you are able to buy, is Sacramento a good market for first-time home buyers? Absolutely, but that's also perspective, right? It's also perspective because for first-time buyers, especially ones in the Bay Area, I have nephews that have just graduated, just started working a year, 2 years, making over $150,000. They can't get a thing in the Bay Area whatsoever. When I priced it out for them, the maximum that they can purchase is 900,000 with putting 20% down for their debt to income ratio to work. So when they come here, it's like, okay, well, I don't even need that big of a house. They can start out something 500, even 600 if it's in Elk Grove or whatnot, that 3 bedroom, 2 bathroom. Now, even if the moving around situation, I think as long as your mortgage is affordable in a way where if you were to rent it out, it either pays for itself or you only have to put in a little bit. Even if you did have to put in a little bit, think of it this way, okay? And you got to take a look at your numbers. It's just a math problem. Is it worth it for you to rent it out and put $500 extra. Okay, every single month you move around, you do whatever you got to do, live your life however you want to do, but at least you started that real estate game, right? And if you're able to keep it for more than 10 years, like Chia said, regardless if you're actually going to live there for long term or rent it out, you know, if you had it for 10 years and you kept it for another 20 years and you no longer have a mortgage for this house, absolutely, it's still a win for you. So I'd say, this is the reason why our home prices continue to rise, because it's a fantastic place for first time buyers. It's a fantastic place for retirees, and it's a fantastic place to raise a family. So, in all those categories, this is the reason why our inventory continues to be so low. There's too much buyers coming on in.
Yeah, and another thing I'll add to that too is if you are planning on starting your real estate portfolio, like where Lisa mentioned, if you're able to buy a home, if you qualify to buy a home that has more rooms but you don't really need it, maybe you could rent out the other rooms, get creative with that. And then eventually your mortgage is covered, it's easy on you financially, and then you keep doing that. By the time you know, you own so many real estate already. And then another thing too is inflation's going up. Like, I don't know if you guys heard, but the feds are putting a pause, right, on the rates
Right.
going down. And so because they're trying to combat the inflation going up. So if inflation is going up, guess what else is going up? Everything else. Your rent is going up regardless, because you know why? Insurance going up, property taxes going up. Like, man, it's getting reassessed every year. I swear, like this week, I got probably like 3, 4 calls from past clients that bought home and said, "Chill, why is my property tax so high?" It's because it got
Mhm.
reassessed. If the value in your area is going up, up, up every year, you're getting reassessed every time, and your property tax is gonna go up. So yeah, your interest rates stay the same, but insurance and taxes are gonna go up with inflation. And if you're a landlord, guess what? You have to bring that cost up from your rental to your tenants. So now the tenants gotta pay more so that you could pay your mortgage. So um it's just a domino effect. And speaking of which, I think it's a good segue to mortgage rates. But thanks for the question, Chris. Rates, here are the rates, as of right now. Conventional 30-year fixed is 7.4, 15-year fixed is 6.8, jumbo is 7.6, adjustable is 7.5, FHA 6.8, VA 6.8. So not much of a change from last week, if I'm looking at it, if I'm remembering correctly. Right, Lisa? Not much of a change, right?
I mean, it went down slightly, very, very slightly. Okay, the last week, 30-year fix was at 7.51. Everything was up by, a point zero 0.08, a point one percentage wise. And yes, the Feds did announce that they're not going to change anything because consumers are still buying, guys. Consumers are still buying because it is still more favorable in most cases for you to be a homeowner than to continue to rent. Exact same example that Chia just brought up earlier. Everything is going up, rent is going up, consumer goods are going up, right? Everything, every restaurant that you go to, food markup price, everything is much much higher. So they need to curb that with something. And what are they going to curb it with? With home ownership. It's a double-edged sword sometimes, right? You do the right thing, you do what you're supposed to, and invest in the real estate and stuff like that, and then you get penalized by increased property tax, by increased interest rate to cushion for inflation. But either way, it's still more favorable to us as homeowners.
Yeah, comparing if we were to rent the same home that we're living in right now, it's definitely more favorable.
Yeah,
Um, because again, you guys have tax advantages when you guys own a home. There's certain strategies you could implement when owning a home versus renting a home, so things like that. Um, so again, you guys just gotta find out where your current situation is like, what's your goal, and then from there, typically you will be able to find the answer whether you should be buying a home or not.
yeah.
And Lisa, let me ask you, because I get asked this a lot. I don't know if you do too. If the rates, let's say if the rates go up by like let's say somebody sees a today's live show and they're like rates are at 6.8 FHA, yay. And then they lock in their rate next week and it's at 6.9. How much of a payment difference increase does that do
Ooh,
to the mortgage?
okay. I mean, it depends on the purchase price and everything like that, right?
Let's
But let
just
me
say
go.
it's 400K.
400K. Okay. 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 Let me bring it up.
What's going on, too? Good to see you, man. Minnesota in the house.
400K. Okay. I'm gonna put 400K
Uh-huh.
on an FHA loan. Okay. Most of our
Mm-hmm.
first time buyers use this type of loan. Okay.
Why are you pulling that up?
6.88. Next week it's 6.9, right? Or let me
Yeah,
do it
just
at
to
least an
safe.
eighth of a point. Yeah, I'm gonna do it at least an eighth of a point. So 6.875 plus 7%. Okay.
Okay.
Or yeah, 7%. So that is a difference. Okay. Of about $32.89. That's it. It's not
About
that big a difference.
$32, okay?
Correct. But
The
again,
reason I
guys, that's on a $400,000 purchase with 3.5% down. The higher that amount is, the more the difference is eighth of a point is going to make a difference.
on average, when it goes up like point one or so, right? Like that
Hmm.
scenario, it's like $30 to $50 around there, right? Give or take, right?
Depends. So here I'm going to put in for 500,000, right?
Uh-huh.
500,000. Okay. You're looking at 41.11 $41.11. Okay. But let's just say, for instance, somebody in the Bay Area ish. Okay.
Mm-mm.
Okay. And let's say at at a minimal, guys, it's like 1.3 million. Okay. I know it's a crazy amount for us here. Okay. Even at a million, the difference is really only $106.
Okay. The reason I want you to share that is because for some reason, a lot of first-time homebuyers think that when the rates go up just point one, that their mortgage payments is going up a couple $100.
So
And the reason I wanted Lisa to share that with you guys is because to debunk that idea,
yeah.
and to not be too worried about that when you're already if you got pre-approved, okay, with Lisa,
Hmm.
and your Lisa quote you guys during that time that hey rates were around 6.8, and you end up finding a home a month later and it jumps up a point like that, like point one or so, don't be too alarmed about it because and think that you have to redo your pre-approval again. Yes, it's good to look at the numbers again to see how much of a payment it changes so that you can buffer the closing costs and the payments and all that. Yes, it's always good to do that, but don't be too alarmed to where oh man, like I can't qualify for that same home that I got pre-approved for no more. No, it's not gonna change that much in your payments, and you know, like you can still make up for in other areas of the transaction, such as credits from the seller, price reductions, you know, things like that, or you know, credits overall. So, um, the best way to go about that is really just to talk to your loan officer and then hear from them, you know, because most of the time it's like 30, 40, $50, you know, on the average home right now, at least that we're seeing, you know. So yeah, thank you for sharing that, Lisa. But
Yeah, absolutely.
this is the mortgage rates for today, y'all. Randy said, "Do you guys work from home like software engineering?" No, my job, Randy, I can't work from home, you know, because I would prefer to open up the doors and show people the homes and all that, meet the clients face to face. I don't care what anybody tells you. Real estate you cannot buy like how it's Amazon, you know, how you're just scrolling and looking through items all day and getting it prime rush to your house. I don't think real estate can be like that because there's just too much emotions involved when you're buying real estate, you know, unless you're super savvy and all you care about are the numbers. But even that, investors still want to look at the home to make sure that everything isn't photoshopped because again, like I pay my photographers to edit the photos to make it look nice so that people could come in and want to come in and look at it. I don't pay them to take the picture. The angle, anybody can do the angle, but the editing is the impressive part that we look for when it comes to professional photography. So like with that, and especially with now with AI, you could be fooled. And so can you imagine buying a home and you don't really you haven't seen it, you're just buying it based off of the pictures? I mean, I've heard a lot of stories about millennials doing that and regretting. So I don't know. So with that, hopefully I answered your question. I don't work from home. Uh,
Yeah.
I mean, I bring my office with me everywhere I go. And my office is in here, and
That's
my
true.
laptop for contracts and stuff like that. But no, I don't need to print anything out, and everything is all digital now. If that's what you meant.
Yeah. So for me, on the mortgage side, ever since COVID, that actually was a huge game changer for us because of COVID. A lot of our clients learned how to be on Zoom if need be, because a lot of times when I'm doing the options and the charts, it's really hard for people, especially first-time buyers, to understand the numbers that I'm just spewing out, right? So I'd rather have that Zoom interaction with them so that they can see, oh, okay, these are the options. Let's play around with the numbers a little bit more, see if which option works best for you. And I'll show you guys that in a little bit too.
Yeah. Well, I mean, that's a good segue. Go ahead. You could go on. Let's talk about your topic of today, Lisa.
Okay, awesome. Because the rates of the way that they are, I do want to show you guys the difference of buying down the interest rates to see if it's worth it for you. And then you segue into whether or not, hey, well, when we refinance, is it really something that we want to do, right? And on top of that, I want to show you how you can pay off your mortgage faster if you feel like, oh, okay, well, since I can't buy anyway, how do I jumpstart this? Okay, I'm going to go ahead and share that with you here.
All right. What's going on, pal? Good morning. You say you're sharing your screen, Lisa?
Yeah, I'm going to share my screen.
Okay. I see it.
Okay, yay. All right.
Oh, you might
Oh,
need to zoom in. Yeah.
is it big enough, Jeff?
No, you can't see
Okay.
it. You might have to just zoom in and scroll as you're going over each line.
Okay. Okay. Are we seeing it? Okay.
Oh, you made it smaller. Okay, there you go.
Okay. Are we good?
Yeah, I think we're good.
Okay. All right. Okay. So I put this example as a $500,000 house, somebody putting 3% down. The loan amount is 485. Earlier, you asked me that question. Hey, when the interest rates do change, what is the difference? So in this scenario, you guys get to see that as well. Okay. When you're buying down an interest rate, people get confused here. Hey, if I'm buying down a whole point interest rate, how come the interest rate didn't drop a whole point as well? It doesn't work that way, guys, just so that you know. Okay. It's kind of like this: when the interest rate changes, on our side, it also shows the difference, how much it takes to buy down a certain point. So let's just say, for instance, today's market, right? The interest rate is 7.375, but to buy down 1 point gets you 7%. But sometimes when the market is quote unquote good too on this part, you probably could buy down to 6.5% with only 1 point. In this scenario, it's 1 point that gets you to 7%. Okay. Then if you buy down 2 points, it gets you to 6.625. You guys see here, this is the monthly payment. So what difference is that when you're talking
Mm.
about savings and such, right? So we talked about earlier, okay, to buy down the interest rate here, here's that 1 point that you're looking at, here's that 2 points. So when it's 1 or 2 points, it's 1 or 2 points
Mm.
of the loan amount, okay? Not the purchase price, but the loan amount, okay?
Wait,
So
so for the loan amount of 500K purchase price, it's $4,800 to buy at 1 point?
It's because this person's only putting 3% down. If they put more
Oh,
down, then the loan amount is going to be less. So that's going to be less for them too.
so this is based off of 3% down.
Correct. This is based off of 3% down. So the less,
Conventional loan too, y'all.
correct. So the less down payment you put down, the more it's going to cost you to buy down the rate. Okay, because the percentage is higher because the loan amount is higher.
Yeah.
Okay, so if you look down here of these options, option number one, if you're not buying down the interest rate with all of the closing costs and whatnot. And again, I cushioned this on a high, you guys, just because that way you guys are most prepared. Nobody can take a chunk of this from you. Okay, if it comes to be less, you put that in their pocket. It also gives you the opportunity to say, hey, Mr. Seller, I love your house so much. I know you got 10 other people who love your house, but I love it so much. I'm willing to pay my closing costs and yours. And sometimes that little extra will win you that deal. Okay. So if you
Yep.
look at these numbers just like this, okay, this is how much it's going to save you. If you buy down by 1 point, it's going to save you $123.06, which means, guys, goes back to the point that we were making earlier. If the interest rate drops, right, from 7.375 to 7%, you're saving $123. Okay. That's 3/8 of a point. So it's not a huge difference. It makes a difference when your debt to income ratio is right there on the cusp. If qualification for this loan is 50% debt to income ratio, and at option one, you were already at 49.9%, an eighth of the point could push you over over that threshold. That's where it's gonna cause that situation that's unpleasant if you don't have a little bit more wiggle room. Okay. So in this situation, if you're saving $123 every single month, this is how much you'll be saving a year. Okay. And if you take that and divide it by the cost for your buy down, this is how long it's going to take for you to recoup that cost. That's a little over 3 years. Okay, guys? If you were to buy it down even further with 2 points, this is how much you're going to be saving. This is the annual savings, and this is how long it's going to take you to recoup that cost. This is important to know because when I show you guys the refinancing chart, okay, if you were to refinance, okay, is this big enough, Chia? Should I make it bigger?
Zoom in a little bit more, yeah.
Okay, we're good?
Yes.
Okay, awesome. So you see how the equity in the home, now you purchase this home, you put 3% down. This is doable if the value of your house, earlier you purchased a house for 500,000. If the value goes up to 517, you can pretty much refinance. Now I put this for 1 year, okay? But realistically, hey, if the equity of your house went up in 3-4 months, you can still refinance. Okay. I'm just using this as a small example. Okay. So
Yeah.
let's just say, for instance, you get this loan and everything, and it's down to 6.5%. Does that make sense for you to refinance yet? So let's go down and take a look at this. By the way, guys, I want to show you this because a lot of times there's going to be lenders that tell you, hey, it's free to refinance, it's free to refinance. The cool thing about refinancing is all the closing costs that you typically have to have when you're purchasing a house, you have to pay that up front. Okay. But in a refinance, you can actually add that onto your loan. So earlier when I priced it out for you guys, if you're buying a house that's 500,000 and you're putting 3% down, the loan amount was 485, right? Well, because the equity went up and everything like that, you can add all these closing costs into your loan. Now your loan amount is higher. Okay, your loan amount is going to be roughly 491, 150 to cushion for all of that. Okay, you still have mortgage insurance. Okay, you still have all of that. So from here to here, you'd be saving $122. So let's go back to the other chart. Okay, if you buy down the rate, it costs you only $48.50. You're already saving $123, and you saved it right off
At
the
only
bat.
rate 1 point. That is 1 point.
Correct. You see, so even at 6.5%, you're already saving. If you chose this option to begin with, you're already saving that amount, right? Then, if you look at here, the annual savings, life of the loan. This is the life of the loan, yes, but remember, you already had this house for a year, which means you're adding an additional year when you refinance it. You go back to the 30 year. refinance. And realistically, with all of the refi costs and everything like that, you're really only saving $350, even if the rates go down to 6.5%. So it might be in your better interest to just buy down the rate to begin with. Does that make sense?
Mm, 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 mm,
Okay.
mm.
Now look at this. If it takes 3 years to accumulate this type of equity, which in this market that's not going to happen, right? You're actually losing money because you lost those 3 years. You got to start that 30-year all over again. Okay. Now in this situation, take a look at this, guys. If you refinance and you did a 25-year, same rate, okay, your monthly is actually higher, right? It's higher by $89. But because you're removing 4 years of the life of the loan, you're actually going to be saving a little over 121,000. So when
Mm.
you refinance, you got to take a look at the whole entire picture, and hopefully you have a mortgage strategist that will also show you this entire chart to see which one is the best for you. If your income and everything changes, then you might want to put in a little bit more to help you get to that point faster. Why would you want to pay off your mortgage early, right? Well, here's the thing. It's like, hey, if you can pay it off more early and you have less debt, this is kind of that Dave Ramsey thing, right? You kind of put a little bit of a mix. Instead of waiting for that to happen, you put an extra additional amount. So earlier, okay, if you chose option number one, your interest rate is 7.375. Okay. You started out with 485. You add an additional $100 here, and we can include this link, and you guys can play around with it yourself and see, okay, if I were to do this, look at that, guys. You just saved yourself almost 3 years, 2 years and 10 months. You just
Mm.
saved yourself over 82,000 just by doing an extra $100 every single month on your payment. You might not even need to refinance. It might be cheaper for you just to do it this way.
And that's what Lisa is showing you guys right now. This is actually some advice we give to like our previous clients before that bought a home and wanted to refi, and we told them, don't gamble that the rates are gonna come down, because what if it doesn't, and what if it stays the same, or worst case, what if it goes up? How do you still make it more favorable for you? And to make it more favorable for some people, instead of putting that money, that $4,800 that Lisa was showing earlier, for example, in this case, to buy down 1 point, we were advising them, why don't you save that money and use a little bit to pay down your mortgage principal? So then by the time that you guys are planning on refinancing, worst case, if the rates didn't change at all, you could refinance based off of that loan amount that you have left, because you've been paying extra. It is going to be a smaller payment. Yes, you are starting over on your terms to a 30-year if you do that. But I feel like if you did it that way, you're not paying anything extra towards rates. You're just utilizing the money you already have already. And you're already skipping all of those years of interest by paying extra every month with the money you already plan on using towards buying down anyways. But of course,
Right.
this is not gonna work for every homeowner out there. It's only if you already know what your end goal is gonna be. Everybody's end goal of a home is gonna be a little different. Some people are more riskier than others. So you just gotta play by ear.
Yeah.
Can you include that link? Can you put
Yeah,
that in the comment
absolutely.
section?
Absolutely.
Because it's a good tool to have. A lot of people ask us about how much do I need to make extra to pay off my mortgage sooner. This is how you do it. This is what a lot of people talk about. And there's other ways as well on how you could also pay your mortgage faster also, by utilizing other funds, like kind of like it's similar to like other strategies that Dave Ramsey them recommends, to pay off your debt. It's kind of like the snowball effect and things like that. But this is towards your mortgage, you know.
Right. Right. Absolutely. I mean, um, we can get into velocity bank at another time and whatnot, but this is one of those things where it's like, hey, um, I don't know if you guys ever heard of this game called Cash Flow. It was in the late '90s, right? It's a fantastic game. I just learned how to play that with my nieces in Toronto. I didn't even know it existed. I was like, oh my gosh, this is
What?
crazy.
It's by Rich Dad Poor Dad.
I know all this
I
time.
have
Okay,
that game.
I'm I live in a cage. Yeah, I live in a
Yeah,
cage.
that's a good game to have because it gets you thinking.
Absolutely, it
It's
absolutely does
literally
get you.
Monopoly in real life.
For real. And that's the thing, guys. It's here's the thing. You continue the 9 to 5, continue the 9 to 5 and everything like that, and wait until you retire at 65. Now it's like 65, 70, you guys. And you continue to be in that rat race. And in order for you to get outside that rat race, you gotta bring some sort of passive income and other income stream enough to pay for whatever debts that you have or whatever your lifestyle is, right? So you can get out of that, paying off your mortgage a little bit earlier so that you can have that leeway of, hey, in 20 years from now, in 15 years from now, take a look at where your age is. What difference will that change in your life and lifestyle when you say, hey,
Yeah.
I don't even have to worry about a mortgage anymore? That's most of what my bills are on a monthly basis.
Yep.
You can free up that money and reinvest it in something else. And then hopefully by the time you do retire, whatever your guys' income is right now, let's say, how cool would that be if that doubled when you retire, but then you're not even actually working?
Yep. Some people like to be a little bit more savvy with their equity too, so they tend to will not want to pay off their mortgage early because they're constantly pulling money out to invest in other ventures, so if you're that
Yeah,
savvy investor, that's fine too, if the number makes sense.
absolutely.
We know plenty of people that do that, with their mortgages. So yeah, just get creative with it.
Hmm.
Randy, do you guys ever water raft on the American River?
Yes.
Algove is a good area to Airbnb. Yeah, Algove is definitely a good Airbnb spot. Because it's in the middle of everywhere. Like what I see, is whenever people come to Airbnb in Elk Grove or that area, they're either going to a wedding that's happening in Napa because it's more affordable than getting an Airbnb in Napa and just make that drive, or they're going to like Gaul because it's fairly close to a lot of nice, desirable areas, for tourists and people that's out of the area, So I'll if you can find any area that has amenities like that, Randy, it's gonna be a good Airbnb. It doesn't necessarily need to be in Elk Grove. It could be, like I think Lisa has one in Napa. You know,
Actually, it was Sonoma, but
Sonoma, yeah,
we already saw that one. Yeah,
yeah. So like, imagine that. And do we water raft? I kayak fish. I
I
do
love water.
love water rafting though.
Yeah. We went a lot more when my kids were younger, and they liked the outdoors a little bit more. But now it's been so crazy busy that we haven't had a chance to. But yeah, I love
My
water
kids are
rafting.
all older. They probably think they're too cool to water raft with mom and dad.
Yeah, a little bit, a little.
Randy says, if we buy a house, what do we need? 2-year income, credit score, down payment?
Great questions, Randy. Yes, you need a work history of 2 years, not 2 years income per se, right? So say for instance, if you start out and you had five other jobs, that's totally fine too. As long as all of your jobs combined together equal that 2 year gap, you would take whatever income. If you're a W-2 employee, we would take whatever that new income is. And then, of course, yes, your credit score and your down payment does make a difference. The more you put down, the less your monthly payment is going to be, the higher your buying power is going to be.
There you go. Not necessarily a 2-year income, 2-year work history. Okay.
Yes.
Um, what about with business owners? It's different.
Yeah, business owners is different. So business owners, typically it is a 2 year average, right? However, if you've had your business for over 5 years and your credit is good, we actually only have to have 1 year average. So if last year you didn't do as well and this year you made a lot more, then we would only have to average that current year.
It's more flexible with business owners in, huh?
Yeah. Correct. I've actually had a lot of business owners who are like, "Oh, how come, they got turned down somewhere else because their income because, they thought it was like that 2-year history," like you mentioned. My busiest times actually are in, the 4th quarter. It's busy in the 4th quarter just because I'm preparing my business owners before you file taxes and everything like that, right? Because whatever you tell the IRS, okay, whatever you tell your Uncle Sam your income is, if you make $1 million, but you write off everything, and now you're down to $50,000, that's the income I have to calculate, right? So it's
Yeah.
great as business owners because I'm a business owner myself. It's great that we have all of these tax write-offs and everything like that. But when you're telling Uncle Sam this is how much you make, that means you also tell the bank that's how much you make. So
Yeah.
before that happens and everything like that, talk to your mortgage strategist and talk to your CPA. Okay, what potential, but also not pay Uncle Sam a huge chunk.
Yeah. There you go, Randy. Thanks for the questions. Are you guys ready to react to some videos?
Yes.
Okay. I really, really want to share this with you guys.
They are offering 1% down mortgages right now. You don't
Renting is now cheaper than owning in all of America's 50 biggest metro areas.
you guys don't understand. The housing crisis is going to come from people who are buying and can't afford it. I'm not going to break down the 2008 housing crisis. They were being given houses they couldn't afford, and a lot of it was based on a thing called a variable loan. But now
Variable loan, adjustable rates.
That makes sense. Everything he's saying it makes sense so far.
you can't do that anymore. So what do? You go around it and you do things like Zillow offering a 1% down, and they will match with a 2% grant that falls off after you pay.
1% loan, a 1% down with a 2% grant. Well, we know about this program. It's not just Zillow doing it. There's a lot of programs out there that are doing this. Yeah.
It off to get into a home. These kids are going to be like, good, I can get into a home. And that's one of the reasons homes are staying up right now, because people are able to afford it, even though they can't. And so now they're going to be paying $4,000 a month in mortgage payment instead of $3,800, and only 190 of that is
4,000 based off of what? What's the purchase price?
So yeah, I was like, continue. You might say it right.
going through their loan.
Willie?
So all of a sudden, after 4,000 plus tax, insurance, maintenance, and HOA and all the other, they're paying $50,000 a year, and they're only paying $3,000 off their mortgage. And they're like, after 2 years, they paid $100,000, and they only got $3,000 off of their principal, which is where the interest is derived from. And they give up. They walk away. They can't afford it anymore. They are.
Yeah, there's a lot of detail being missed right
Yeah,
there. Like $4,000 a month based off of what purchase price, and how
yeah.
much did they put down? Okay, yeah, they put down 1% from a program through Zillow, and then they're getting a grant of 2%. So there's a lot of Cal HFA programs like that too. There's other unique bank only loan programs are similar to this as well, but you're similar, you're familiar with this loan
Yeah.
strategy, right?
Yeah, I mean, we have that too, but we rarely ever use it because once I show it to the consumer, it's like, guys, I mean, the more less you put down, the more expensive it's going to be. And then you got those silent, especially for the Cal HAFA loans and whatnot, they're silent loans. They're still loans, which means when you refinance and when you um,
It needs to be
uh,
paid off.
sell it, right? It has to be paid off. And that's the thing. When you have those types of loans, it's going to take longer for you to build up the equity to refinance out. So even if the rates are favorable, unless you pay that loan off, right, you might not be able to take advantage of that.
Yeah, and for the video to state that the crash is gonna come from people that can't afford their homes, but they're getting into homes because of programs like this. I feel like that's a little bit, what's the word I'm looking for? It's I don't
Misleading,
100, huh?
misleading.
It is very misleading because then that's not entirely true, because um I mean, I don't know what other lenders and agents are telling their clients, but like whenever we sit down with a client, and we're doing all this budgeting with them that you see us do here on the show, we don't just consider their DTI as what most lenders look at. We're talking about gas, talking about food, we're talking about all that with them, actually doing a budgeting plan with them. And we always ask them, like, if you can't, even though you're qualified to buy a home up to this amount, like, if you don't want to be house poor, then you're gonna have to compromise and buy this home instead. So, like,
Yeah,
I and right now with today's economy, you can't really compare it to '08 because it's very different. The loan criteria is different now. It's a lot more strict compared to last during that time. And so because of all that, there's a lot of these checks and balances that go on the application. And for a person to buy a home right now, even utilizing this some a program like this, with the way the market is right now, inventory is super low, prices are appreciating, and because of the competition level and all that. Worst case, if you call into your bank and say that you need help, they're just gonna tell you, no, we can't help you right now. But I guess the only choice you have is to sell your home because you have a lot of equity. That's what's
right.
that's what's really going on right now, real time, like people have equity coming in, and even if you refinance, most banks won't refinance your loan if you don't have more than 15 to 20% equity in there anyways, right?
Right. I mean, I don't know if he's going to make that point at the end of this video, Chia, but yes, it is misleading because it's subjective. And the reason why it is based on my chart earlier that I showed you guys for a $4,000 mortgage, you're buying roughly a $500,000 house, putting 3% down, right? Um, and realistically, if your debt to income ratio, they allow you to qualify for up to 50% debt to income ratio. But then again, the banks don't qualify you on
Are
how much
offering
tax you're gonna have to pay, food you're gonna have to buy for your family, things like that. Okay. But if you look at that $4,000 and you say, okay, well, my wife or my spouse wasn't really on the loan. I know we have another income coming in. I have a side gig. We're good to go. And just like Chia said, it's misleading in a way because in 2008, the reason why it's crashed, yes, it was because the loans were not as stringent. The guidelines for that was not as stringent. So right off the bat already, they didn't really truly qualify. But because they got into that variable loan that he was talking about earlier, the mortgage was much, much smaller. So it looked attractive from the
Yep.
very, very beginning. But then when that didn't last anymore, because sometimes it was only 1 year,
Rates.
1 to 3 years, and they weren't able to sell because there was no more equity. The difference is now is because we do have equity. Chia touched based on that, and that's right where the reason why you won't see that happening in 2008 because as if it's worst case scenario, somebody just made $100,000, even if they could not carry the mortgage anymore, they're not going to be in that type of situation because there's no way anybody unless they got really, really bad advice to walk away from $100,000 worth of equity, not even
Yeah.
trying to sell the house and go back to rent. Okay,
I
that's
mean,
just silly.
we see it even right now in every market. Sometimes there are those homeowners that just don't want to go through the traditional sale of a home, and they just want to get done with it. Even though there's a lot of equity in their home, they're willing to sacrifice some of that equity for convenience. And when you're going the convenience route, there's a price that you're paying, and that's majority of your equity. Like, that's how a lot of investors get their deals, is they find these owners that are in a desperate need, and they're able to buy it for a heavy discount, even though the home has so much equity in it. They fix it up, yes, they do all of that, spend money too, so it needs to be profitable, I get that. But sometimes people do prefer the convenience route, and so they sacrifice their equity. But
Yeah,
again, in this case, what this gentleman right here is saying, it's a little misleading because if you were using this program today, you're not using it for a variable rate, you're using it for a fixed rate. So let's say you use this 1% program down payment and you're getting 2% grant. most likely it's a fixed rate. Most buyers right now that are like 99% of buyers right now that are buying a home with a mortgage, they're getting a fixed rate. They're not getting an adjustable rate. Most of the time, people that are getting adjustable rates because they know the end game. They already know that within a year or two before the rates change, they're selling it. They're flipping it. They're doing something with it already, or they're refinancing it. Um, yeah, most first time home buyers right now are not buying with a variable rate. So in '08, with like what Lisa said, when the variable rates went up, that's when they couldn't afford it no more. That's when they were walking away from their homes, and there was no equity. Right now, none of that's happening. That's why the foreclosure rates aren't high like what everybody wanted it to be, and that's why people are still buying. I'm curious to see what the comments are saying. It's not that they didn't learn their lesson in '08. They did, but the lesson was to do whatever you want and get bailed out. Bro, I'm still trying to figure out where I'm supposed to work to afford a $3,800 mortgage. That's actually crazy, paying $50,000 a year only to remove 3K off the mortgage. So, when you're getting on a 30-year mortgage, yes, in the beginning of the years of your mortgage terms, you are paying more towards interest, okay? Because remember, if you're putting a low down payment, banks are trying to recuperate as much as they can back, so that way they could go back out there and lend more money to people to buy homes. So in a 30-year term, yes, you are paying majority from your mortgage payment towards the interest. Um, that's why I was saying earlier to one of the comments, that if you're planning on only living it for under 10 years, then man, you're gonna shoot yourself in the foot because majority of those earlier years of your mortgage is just interest only. Not interest only, but majority interest. So it doesn't really take that much of a crack at your principal balance. So if you're gonna sell, then you're probably breaking even or losing money. So 10 plus years, y'all. Buy a home right now. 10 plus years, you'll be good. You'll be glad you did versus renting for 10 years.
Yeah.
Oh,
Yesterday, we're with Barron Trump. Barron's a very interesting guy, the son of Donald Trump, 6766. Yesterday, we're with Barron Trump.
oh, that's not
Barron's
the
a
right one. What is going on? Okay, let's share this one.
We got big problems here at Pizza Hut. Pizza Hut is now laying off all their delivery drivers in California due to the new minimum wage law in California that makes sure that fast food workers earn $20 an hour at minimum. And this is something we're going to see more of in California, is this fast food worker mass layoffs. Now that they've increased the minimum wage so high for fast food workers to $20 an hour, we're going to see fast food restaurants like Pizza Hut as well as Taco Bell cut labor. They're going to automate. They're going to try to operate with as few workers as possible. In fact, we already are seeing a McDonald's in Texas operate with no humans whatsoever, a fully automated McDonald's in Fort Worth. Folks, this is the future of fast food, especially if states like California keep jacking up the fast food.
How do you feel about that? You hear me, Lisa?
Yeah, I can hear you. I didn't. It was so muffled and everything. I had a hard
What's
time
that?
understanding on my side.
Oh, okay. Well, we won't take too much longer because we're really over. But um, this is actually true to some degree because the other day I went to eat out at a Taco Bell, right, Lisa? And
Mhm.
I kid you not, the cashier did not want to help take my order at all. You know what he was telling me and a bunch of other people? Can you go to the machine right there and put in your order?
Yes, that happened to me at McDonald's.
I was like, "What? But you're right
Yeah,
here. Can I
yeah,
just
yeah,
get it
yeah,
through you? Like, I have my baby with me. It's more convenient that you just take my order instead of me dialing everything and restarting it every time he touches it." And he goes, "Fine." Then he took my order, and I'm like, "What?" And so,
yeah,
like, I think they're being trained now from upper management to tell people to go and use the kiosk. But
yeah.
what that manager right there or cashier don't realize is that if you're encouraging that, you're encouraging your own replacement.
Absolutely. Absolutely. And that's the whole minimum wage thing. That this started happening because we already knew what's going to happen. They were going to replace real people with machines. That's exactly what happened to me. And you know what the sucky thing was? Gee, I don't think I'll ever eat McDonald's again, because when I was there, I'm very specific and I'm very particular. I rarely eat fast food, but I like my filet of fish crispy, super duper hot. And in the machine, there's no way for me to put that in whatsoever. And just so that you know, because I'm so particular with my fast food, I got a filet o fish that was soggy and cold, and I had it with a milkshake and a small fries. Okay, $17 for this
Yeah,
from a
it's
machine.
expensive.
Yeah, I had to go back. I usually rarely make complaints, but it was so bad. I was like, I asked for extra crispy. I asked you guys for that, and it's soggy.
Yeah, it's so expensive now. Eating through a fast food is like might as well just go to an actual buffet or like a restaurant, pay the same price and get more. It's so crazy. Get quality real food. But yeah, I was like, damn, $17.
I know,
Yeah,
I
mhm,
know, because
it's
I put a
expensive now.
special order in to have lettuce, tomatoes, and onions in there, and that cost me $17, you
Do you
guys.
know that Wendy's right now has a AI menu
What?
to where if you're going in to order food, fast food or inside during a busy peak hour, prices are jacked up automatically. So sometimes if you walk up to the cashier might tell you, if you don't want to pay that premium, come back in 2 hours and it'll be lower.
What? Well,
Yeah, so
see,
the menu
I
adjusted the
love fast
price
food. I
based off
know.
of the foot traffic.
What?
So that's why they have cameras now. I don't know if you know, they have cameras now on their drive-throughs in their stores to where it checks the foot traffic and the driving traffic. So if it's a lot of people per hour or so, it jacks up the price.
Well, I did not know that. Well, see, you know what? I
Wendy's.
don't eat much fast food, so I'm glad.
Oh well, yeah, Wendy started that. So I won't be surprised if a lot of other fast food starts filing suit after that. You know.
But with that price, I might as well go sit down at a restaurant and have a meal.
Uh-huh, uh-huh, uh-huh. Because right now fast food's not even fast.
No,
You still gotta wait a while.
please.
So everything is changing. Okay, we're gonna close it up, y'all. Thank you guys again for joining us today on this live show. We will catch you guys next time. Okay. Peace out, Chi Chi fams.